the ability really to establish relationships. That's something that I've been really gifted with and good at most of my life. And I largely attribute that to having to uproot myself. My entire investor base turned to me, and they had never met me. They didn't know I was a 23-year-old kid, I don't think. And they said, well, Brad, what are you going to do now? I just saw this huge door of opportunity open. And so, never having drilled an oil well, not knowing the first thing about building a multi-million-dollar business, but knowing I could find people like a good attorney and a good CPA, I printed up some letterhead and business cards and on the door, Third Coast Petroleum, and there I was, just raising literally millions of dollars, hired people, and over the course of a decade, built a pretty nice sizable company with drilling programs here in Texas, Oklahoma, and Louisiana. But that's largely how I fell into it. I wasn't looking to raise capital. I actually learned at a very young age, and it just stayed with me my entire life.
What was it that your early employer saw in you when he hired you and said, I'm gonna hire you, and you're like, for what? He obviously saw something in you that he felt you would excel at, and you didn't even know how to do it. What is it do you think that he saw in you?
I think number one, probably a little bit of confidence and cockiness. I won't say that I had a chip on my shoulder, but you definitely need to be confident. And the other thing I think also was the ability really to establish relationships. That's something that I've been really gifted with and good at most of my life. And I largely attribute that to having to uproot myself as a kid and basically, make friends and build relationships, because my dad was a CEO and an entrepreneur. And so about every 3 to 5 years, we were uprooted and, we had to move. And so I think it was just that ability to very quickly build relationships and trust with others. Maybe that's what he saw in me. The other, I think, was just I was, energetic. I wanted a great opportunity. And he just saw in me something that I guess he was attracted to, much like I've seen in others, obviously, that I've hired into my organization. But I think a lot of it was just the confidence, and just the ability to think on my feet and just be real sharp.
So confidence, I think you said building relationships several times, and this was back, you said before, for the internet. I don't know, were you doing this over the phone, in person? And then more importantly, how did you build relationships, whether it's in person or over the phone? Because you were probably talking to a large number of individuals, and you can't afford to spend days and months building relationships. So how did you figure out how to build relationships? I would say more efficiently, though you can't hurry it either. How did you, what did you find works?
So it was all done over the telephone for the most part, reaching out to people. And what I've learned, having done this now for close to 30 years, and also, of course, doing it at the highest levels, raising tens of millions of dollars from, family offices, insurance companies, pensions, trusts, sovereign wealth funds, is it's more of a journey than a sprint. And I think what's made me successful and also teaching others is I've been able to take my knowledge and really systematize and codify it. And so as I teach people, I talk about key concepts and key principles, things like the 4-step blueprint, the trust sequence, the validation phrase. And when you're talking to a potential investor, what I've always really done is backed away and just tell them right from the get-go, right now, I just don't have anything that I can really talk to you about from an investment perspective. Here's why. So it's a little bit of the negative sell or the takeaway, but it's really just getting to know that other person. Psychologists have shown us that if you show interest in another person and really get them to talk about themselves, that's what developing a relationship is all about. And so, I just basically ask them, have you ever invested in something like this before? And they're going to give you an answer. Well, great. Tell me about that. When you invest, what are you looking for? Are you looking for growth? Are you looking for income? How important are tax considerations to you? What's your time horizon? And so it gets back to, what we call the KYC, know your client roles in the securities industry. But it's really, I think, uncovering the temptation. what's going to get that person to move forward with you as a potential investor? Because if you can uncover their temptation and find out why they're wanting to invest or what they're wanting to do with the money they're investing, you're 9/10 of the way there.
That's interesting. Let's talk about motivation when you're talking about, because people say, well, I want a return, or I want to hedge, or I want to get tax benefits. To what degree do you dig a little deeper with that person? Is that normally satisfactory to go with that answer, or do you try to go a little deeper, or what's behind that motivation?
Yeah, I go much deeper. One of the things I talk about is this thing called the trust sequence. Yeah, there's a great book that your listeners can go and Google. It's called The Trust Economy by a gentleman named Philippe de Koner. And in there, he talks about a sequence that takes place in people's minds. There's actually 6 steps to this process. The first is perception. When you meet somebody, man, they're checking you out. And, I like to say to the ladies, you get this a lot better than us guys do, because when that guy pulled up, the first thing going through your mind is there ever going to be a second date? But that's largely what it's about with a potential investor. They meet you, they shake their hand if it's a personal meeting, how you dress, the quality of your presentation materials, if you have a pitch deck, if you have a website, that largely dictates whether they want a second date. But the second step in this process, we call that temptation. That's where you're uncovering the need. That's where you're going deeper. And then after temptation, the third step is what he calls connection. Connection is the most important part, because at the end of the day, Michael, we know investing is all a relationship-driven business. You got to build that relationship. You got to get the people to trust you. And then the fourth step we call validation. I always tell my students that we work with, you're largely wasting your time pitching or talking about an investment until you know that person trusts you. Because the next step in the process is they're just going to say, oh, that sounds great. Can you send me some information to take a look at? Which you do. But then when you follow up and you try to close them, they become real evasive. They're going to give you every excuse as to why they don't want to invest. And it's not you, and it's not the deal. It's largely just they don't know you. They don't trust you enough to physically write you a check. So if you stop and you step back and you build that trust and you allow the other person to really get to know you, you're going to be much, much more successful. You're going to raise considerably more money, and you're going to have much greater conversion with regards to the people you're talking with as it relates to the people that are ultimately writing you checks.
Well, you're right. I mean, many situations you're just dying to make the pitch. You want to close the person
that's
down.
The mistake that most everybody makes. They got the deal, or they've got it now under contract, and now they're in capital chasing mode, and they're so excited that they start pitching the deal way too prematurely in the process. Why? Because they need the money to close the transaction. And so, the best advice I give to people is, look, slow down. And a lot of course, real estate people finally realize that maybe it's better for me to launch a fund so that now I have something to talk to investors about 365 days a year. The fund essentially replaces the deal. And now as I'm raising money in a fund, I hopefully have enough to close on a property or close on a deal when the opportunity presents itself. But the biggest mistake a lot of people make that are new to raising capital is they just pitch way too early in the process. And like I said earlier, that person's going to naturally say, yeah, send me the stuff. I'll take a look at it. But ultimately, they're not going to write a check when it comes time to physically close.